All right, welcome. In this explainer, we're going to pull back the curtain on how financial markets really move. We're diving deep into what's known as smart money concepts. Now, this isn't some secret formula, but it is a way of understanding the hidden logic of price, a logic that's driven by the biggest players in the game.
Okay, let's kick things off with a feeling that I'm sure every single trader out there knows all too well. You spot a perfect setup, you get into the trade, you place your stop loss just right, and then you watch, in frustration, as the price makes a beeline right for it, stops you out, and then immediately reverses and rockets in the direction you predicted. It feels personal, right? But what if it's not? What if it's just mechanics?
You know, a lot of traders, especially when they're starting out, really lean on indicators. But here's the fundamental problem they all share. They lag. They have to. They're built using past price data. So when a really sharp, aggressive move happens, those indicators are still looking in the rearview mirror. They're great at telling you what just happened, but not so great at telling you what's happening right now.
And you know what? It's the exact same story with those classic chart patterns. Head and shoulders, double tops, you name it. They're in every trading book on the planet. And because millions of traders are seeing the exact same pattern, they're all putting their stop losses in the same predictable places. Smart money knows this. They've read the same books we have, and they can use these predictable areas to actually engineer liquidity, turning those textbook patterns into perfect traps.
And that, of course, brings us to the classic frustrating fake breakout. Price powers through a key level, retail traders pile in, excited, and then it just slams back in the opposite direction, wiping everyone out. These aren't random, chaotic events. They are calculated moves, and understanding the why behind them is the absolute key to changing how you see the charts forever. So to understand that why, we really need to define what we mean by smart money. Now, this isn't some secret club or a shadowy group of people. It's simply a term we use for the large institutions. We're talking banks, hedge funds, the ones with enough capital to actually push the market around. The key here is to stop seeing them as some kind of enemy and start thinking about their basic operational needs. At its heart, this is the definition. These institutions have to move huge amounts of money. They can't just log into their broker and click buy on $1 billion position. If they did, their own order would send the price skyrocketing before they could even get filled. They need someone on the other side of their trade. They need a massive pool of opposite orders to absorb their size. And that pool, that's what we call liquidity. Think of it like this. It's a great analogy. A retail trader, like you or me, we're like a speedboat. We can zip in and out of the market in an instant. Smart money, on the other hand, is like a giant cargo ship. It can't just stop and turn on a dime. It needs a huge, deep harbor to maneuver. In the market, that harbor is liquidity. And this is where it gets really interesting when you see it side by side. Look at the dynamic. We follow trends. They have the capital to create trends. We get excited and buy breakouts. They are often the ones selling to us during that excitement to fill their large positions. Look, it's not personal. It's not about hunting your individual stop loss. It's simply that our collective, predictable behavior provides the very fuel they need to operate. And that right there brings us to what is, without a doubt, the single most important concept in this entire explainer: liquidity. If you can train your eyes to see where the liquidity is on a chart, you will start to understand the hidden engine that drives almost every major price swing. So what is liquidity? In the simplest terms, it's just a big cluster of orders sitting on the chart, waiting. Most of these are stop-loss orders from people already in a trade, and the rest are pending orders from breakout traders, waiting to jump in. Smart money hunts for these zones because that's where they can get their massive positions filled without causing the price to run away from them. Okay, so where do we find these big pools of money? Well, they're hiding in plain sight, exactly where you'd think. They are sitting just above those obvious double tops, where all the short sellers have their stop losses. They're clustered right below that clean support level, where all the buyers put their stops. Every major swing point, every clean trend line, you can bet there's a predictable pool of orders sitting right there. Okay, let's break this down step by step. It's like a little playbook. First, as you can see, the market creates a really obvious support level. Next, retail traders see this clear level, and they start buying, putting their stop losses just below it for protection. Now, here's the key part. Smart money wants to buy big, but they need sellers. So for step 3, they'll actually push the price down right through that support, triggering that cascade of stop-loss sell orders. Then, for step 4, they step in and absorb all that selling pressure, filling their huge buy orders at a great price. And finally, once their orders are filled, there's no more reason for price to be down there, and it aggressively reverses and shoots higher. And that really brings us to this powerful quote. This isn't meant to be cynical, it's just mechanical. For a huge institution to buy, someone has to be selling. And by placing our stops in the most obvious, predictable locations, we inadvertently volunteer to be the other side of their trade. We become the fuel.
Okay, so let's build on that, because once you start seeing these pools of liquidity, the whole chart starts to look different. Market structure isn't just a random series of zigzags anymore. It becomes a map, a story of where price has been, and more importantly, a clue to where it's likely headed next.
So think of it this way. A break of structure, or BOS, is basically the market screaming, yep, we're still going this way. It confirms that the trend is strong and continuing, but a change of character, or CHoCH, that's the first whisper. It's the market quietly saying, hey, something might be changing here. It's that first clue that the underlying control might be shifting from buyers to sellers, or vice versa. So that brings us back to that same frustrating question. Why do so many promising breakouts fail and reverse? Let's look at this chart right here. We've got a clear high. Now, what's sitting just above that high? A huge pool of buy-side liquidity. You've got breakout traders with their buy-stop orders, and you've got short sellers with their protective stop losses. That fake breakout you see, that's not a mistake. It's a deliberate raid on that liquidity. Institutions push price up just enough to trigger all those buy orders, which allows them to fill their own massive sell positions. Once they're filled, they have no reason to hold the price up there, and down it goes. You see? It wasn't a failed breakout, it was a perfectly successful liquidity grab.
Now, when these big, aggressive moves happen, they can't just vanish without a trace. They leave clues behind, footprints on the chart, if you will, that we can learn to spot. And the two most important footprints are called imbalances and order blocks. All right, let's get into the first one. An imbalance, sometimes called a fair value gap. Look really closely at this 3-candle pattern on the chart. You have candle 1, 2, and 3. See how the high of the first candle's wick does not overlap with the low of the third candle's wick? That little gap in between, that shows us where price moved so fast and so one-sidedly that the market was inefficient. And very often, price will want to come back to this area later to rebalance and fill those missed orders.
And the other big footprint is the order block. This is the candle that really kicks off the whole move. Look here on the chart. We have this powerful down move that broke structure. Well, the order block is the very last up candle right before that entire sell-off started. The idea is that this candle is where the big institutions first place their sell orders. Price will often come back to this zone to, let's call it, mitigate their position, basically to tidy up their trade before continuing the main move. Okay, so here's the most important part. None of these concepts work in a vacuum. You can't just hunt for one of them. Their real power comes from seeing how they all fit together to tell a coherent story on the chart. So let's walk through a couple of quick scenarios to see what this looks like in practice. Okay, look at this bullish example. See this really obvious support level? There is a ton of sell-side liquidity building up below it. Now, a typical trader might see the price break that level, and they'd immediately start selling, thinking it's a breakdown. But a trader thinking in these new terms, they see a liquidity sweep. They watch the price dip below, grab all those stops, and then aggressively reverse, breaking structure to the upside. Then they would look for price to pull back into one of those footprints we just talked about, like an imbalance or an order block. All right, now let's flip it and look at a bearish setup. Price is rallying up towards an old, clean high. What's sitting up there? Buy-side liquidity. Breakout traders are getting ready to smash the buy button, but an SMC trader, they've already spotted a bearish order block sitting just above that high. They watch as price pokes through the high, grabs the liquidity, and taps perfectly into that institutional selling zone before aggressively reversing. They understood the breakout wasn't the real move. The breakout was the setup for the real move.
So really, this all boils down to understanding the common traps, the psychological and strategic mistakes that cause so many of us to become the liquidity. And if we can recognize these traps in our own thinking, we have a fighting chance to avoid them.
Let's run through the biggest ones, the ones that get people time and time again. First, chasing those obvious breakouts. By the time it looks like a sure thing to you, the move might already be over. Second, trading a pattern like a double top just because it's a double top, without asking, okay, but where's the liquidity and what's the story here? And, of course, a huge one, ignoring the higher time frame. A perfect bearish setup on a 5-minute chart means almost nothing if the daily chart isn't a screaming uptrend.
Okay, so how do we actually use this stuff? How do we make it practical? Well, it's not about memorizing a bunch of new patterns. It's about fundamentally changing the questions you ask yourself when you open up a chart. This table right here sums it up perfectly. It's a total shift in how you look at the market. You have to move away from trying to predict what's going to happen next and start learning to read the story the price is telling you right now. You stop looking for certain signals and start thinking in terms of probabilities and high-value zones. And suddenly, volatility isn't scary anymore. You start to understand it as the very thing that creates the opportunities we're looking for. All right, so let's bring this all home. It is so important to remember, this is not a magic system. It's not a get-rich-quick formula. It's a framework for analysis, and it requires a ton of patience, a ton of observation, and a deep focus on probability, not on being certain. Look, the goal here is not to be right 100% of the time. That's impossible. The goal is to start aligning your analysis with what's actually driving the market, that constant hunt for liquidity. It's about learning to identify scenarios where the story on the chart stacks the probabilities in your favor, simply because you understand the mechanics of why price moves from one zone of liquidity to the next. So, I'm going to leave you with one final question to think about. The next time you open up your charts, just ask yourself this. Are you truly reading the story of price, the story of liquidity and structure, or are you still just trying to guess what's going to happen on the next page? The answer to that question could change everything for you.